Hello everyone, welcome back to our Accounting 210. In this video, we start talking about the meat in chapter 11, standard costs and the variance. So last time we kind of mentioned, we said we follow the similar idea of chapter 10. We said, hey, we still have actual budget and a budget, but now we use the standard budget instead of the master budget. Master budget is for all the units, right? So you sell 10 units, you thought you will sell 8 units, you have the volume variance. But when we talk about standard costs, we basically focus on one unit. So we don't worry about the volume because the volume is one. There is no difference. We basically focus on the flexible budget variance. And then we said that we break flexible budget variance to another two detailed variance for direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. So now let's get started for the direct material part. Okay, let's get started for the direct material part. We carry the example from chapter 10, we said, or chapter 11, chapter 9, still for the tortilla for the chips company. We said we have the information about the direct material for the master budget. Remember, we plan to sell 29,000 cases, or we plan to make 29. Remember, we plan to produce, right? Produce 29,000 cases, but actually we produced 31,000 cases. So we have the variance. So we have the flexible budget variance, direct material, direct labor, and then variable manufacturing overhead, right? So actual is this much, your flexible budget is this much. Say the flexible budget variance, and then for the flexible budget variance and the actual, they both use the actual quantity, 31,000 cases. All the variance is from the different dollar amount, for the direct material, we have this $8,500 favorable, and for the direct labor, our actual is more than the cost. So we have the $775 unfavorable because we are talking about the cost. Higher number means more cost. So you have the unfavorable to your operating income. Now we said why our direct material, the flexible budget variance, showed $8,500 favorable. Why we have this favorable flexible budget variance? Because, okay, two reasons for the direct material. Think about flour, think about salt, think about oil. Ask yourself, hey, I thought for the budget should be $232,500, but actually we only cost $224,000 for this direct material. Ask yourself, why? How can be the possible reasons? General idea, there are two possible reasons for the direct material favorable results. Two possible reasons. One is we used less material, right? We used less material. You know, we didn't waste that much flour. We used the flour very efficiently, effectively. So we used less material. Or because the purchase price of the material is cheaper than we thought. So one is because the dollar amount is cheaper than we thought. Or because we use the less pounds of the flour, or it's a combination of these two, right? So we can break down this favorable variance. Still, we say, hey, it's because of the dollar amount, or because of the pounds, the quantity, or because it's the combination. So we have to break down this flexible budget variance also to two parts to figure out what is the reason. Is it because of the dollar reason or because of the quantity reason? Now we are doing the numbers. We have all this data for January. Number of cases we produced is 31,000 cases. Direct material purchased is 160,000 pounds. And then at $1.4 per pound direct material, we also use 160,000 pounds. Now we have the actual cost. We have the standard cost allocated to each unit. Then we have something in the middle. We have something in the middle. There is no name, but we can just call, I'll just call it the middle item. For the actual cost is the actual quantity times the actual price. So it's still actual time actual. Actual what? Actual quantity times the actual price. For the standard cost, it's a standard quantity times the standard cost. Okay, and then the middle will be the combination of both, right? AS and SS. Actual quantity times the standard price. So I put the formula here, then we are putting the numbers. We focus on direct material. We focus on direct material. Now we need to put the numbers. We need to put the numbers, okay? For the direct material, actual quantity is we actually purchased and used how many pounds? 160,000 pounds. Do me a favor. When you put the actual quantity for the first part, also put the actual quantity for the middle part, right? So our actual quantity is 160,000 pounds. For the price, actually we spend how much? Actually we spend each 1 pound. Actual price is $1.4. Okay, for the actual price, each one is $1.4. For the standard, we want to know, hey, based on the standard, if everything works normal as it is, it should be what is the standard purchase price for 1 pound of the material. Where we should look to, we should look at our standard. The standard is like a menu. For the standard purchase price for direct material is $1.5 per pound. Okay, so do me a favor. When you put this standard price is $1.5 per pound. When you put the standard, also put the standard for this column is $1.5. It's $1.5. And what is the standard quantity? What is the standard quantity for our products, right? For the standard quantity, we totally produced 31,000 cases. We totally produced 31,000 cases. Each case, the standard pound for each case is 5 pounds, right? For the standard, each case, we should cost 5 pounds. We totally produced 31,000 cases. Each one is 5 pounds. So the standard pound should be 155,000 pounds. Okay, so now we can do all these numbers. We said for this difference, for the first column and then the second column, for these two columns, they both use the actual pounds of the direct material. If there is any variance, the variance is from the price. The standard said for 1 pound of the direct material, it costs $1.5. But actually, for whatever reason, because maybe you are handsome, because I'm pretty, right? For whatever reason, our supplier agreed that for 1 pound, we can get it for $1.4. So without the calculation, you can figure out this is a favorable variance. This is a favorable variance, and it's 16,000 favorable variance. The variance is because of the price variance. So we call it a price variance. Our price variance is $16,000 favorable because our actual cost is cheaper than the budget cost. Okay, it's cheaper than the budget cost, than the budget price. So we have a favorable price variance. Now we do the second part. Okay, so we said, okay, look at this difference. They both use the same price. It's $1.5 based on the standard. But they have a different quantity, right? They have a different quantity. Based on the standard, you should have used 155,000 pounds. Based on the standard, you should have used 155,000 pounds. But actually, we used 160,000 pounds for whatever reason, because we wasted 5,000 pounds because we didn't pay attention. We may had some bad products. We have to reproduce our chips. For whatever reason, we used 5,000 extra pounds than the standard. So we have unfavorable what? We have unfavorable quantity variance. We have unfavorable quantity variance. And the dollar amount is $7,500 unfavorable. Our quantity variance is $7,500 unfavorable. Why? Because we should have just used 155,000 pounds, but actually we used 160,000 pounds for whatever reason, right? So we said we add those two together. We add those two numbers together. 16,000 favorable, $7,500 unfavorable. If you add them two together, you will get a number. It's $8,500 favorable. 8,000. You say, oh my goodness, this number looks very familiar. Look at here, because this is our total flexible budget variance. Do you see what I'm talking? We are trying to break down this. Flexible budget variance to two parts, right? We are trying to break down this to two parts. One is only changing the dollar amount. One is only changing the price. If there is any variance, because of the price difference. The other part is focusing on the quantity. If there is any variance, it's not because of the dollar, because the dollar, they are both $1.5. It's because of a different quantity. So we break down this flexible budget variance to two detailed variance, then we can make better stories for our results. How do you get these numbers? I believe after doing actual standard, you should be able to calculate. All the parts, they are straightforward. The only difference, if you ask me, say, hey, professor, which part I should pay attention? I would say maybe this part you want to be a little bit careful, because you have to calculate this number by yourself. The standard quantity. We totally produced 31,000 cases. Based on standard, each case costs 5 pounds of the material. So the standard cost of the quantity will be 31,000 units times 5 pounds for each unit. Okay, so this is all about the calculation part. How do we interpret the results? We will review the interpretation in the next video, and then we will practice a question. Hopefully you will feel better after the practice. But one more time, we break down flexible budget variance to two parts. One is price variance, actual standard. So if there is any difference, it's from the price. The second part is the quantity variance. Actual standard. So if there is any difference, it's because of the different quantity. Okay, I see you in the next video. We will practice more. See you there. Thank you.